The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The global tech sell-off continues here on this Thursday afternoon, live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. As Romaine put it, the global sell-off continues. You can see the S&P 500 losing ground by 0.8%. The Russell 2000, here's the laggard of the day, down by almost 2%. The move into small caps over the past week definitely losing steam here. Unlike yesterday when small caps declined, but still outperformed their big cap brethren. Today, the decline in small caps is a lot bigger than what you see in the S&P 500 and in fact is near session lows as well. So it does raise the question of whether this rotation into smaller companies is actually short covering rather than driven by something more substantial. We're also looking at higher yields across the curve, the 10-year moving up 3 basis points to 4.18%, and euro weaker versus the dollar after Christine Lagarde said the ECB's next rate meeting in the fall is wide open, and that is, of course, a hint that perhaps a second rate cut is coming in this cycle. Romaine?
All right, let's get back to the equity market here because we did try to see a bit of a rebound in some of those tech names at the start of the session, fading as we get closer to the close. A brutal 3-day sell-off right now for the chip stocks and the AI stocks, too. The top stock analyst over at Goldman saying that the payoff from all that corporate AI spending so far has been modest, a reality that's set to become more evident to investors as big tech companies start to report earnings. Those big tech earnings kick off later this afternoon, ostensibly with Netflix. And the bulls, well, they've actually been boosting their price targets into this print, betting that subscriber growth has remained robust. We should keep in mind here, a decent quarter could finally push Netflix shares back to their first all-time high since 2021, if you can believe that, but you need a roughly 7% gain in order to get there. Options market, though, they are pricing in an up or down move of about 9%, depending on which way those results shake out. And, of course, the world of politics still front and center on this Thursday, and with more pressure right now on Joe Biden to reconsider his re-election bid. Blackstone's John Gray, a prominent donor to the Democratic Party, saying he hopes Biden really weighs the physical demands of continuing as president for another 4 years.
This is his decision, but I would hope he considers the really extreme physical toll of this business, of this job, I should say. I'm going to wait and see what happens here.
John Gray speaking a little bit earlier, and Scarlett, a lot for investors to digest, whether you're looking at politics or you're looking at earnings or you're just looking at the technicals in this market. Everyone wants to know which way we go next.
Absolutely. And you mentioned President Biden, of course. Part of his economic pitch is that inflation has eased. Well, last Thursday, we got proof of it with a cooler than expected June CPI report. Since then, you can see here there's been a rotation out of those reliable mega cap tech names. It's all right here. Information technology, and that's really Apple and Microsoft and chip makers like NVIDIA, communication services, Meta, and consumer discretionary Amazon, all down by at least 2%. Where has the money gone? Yes, we know small caps, but also within big caps. REITs, for instance, real estate investment trusts, which are very rate sensitive and would certainly benefit from lower borrowing costs with Fed cutting interest rates. Energy also seen as a big winner in a second Trump administration. Financials, industrials, and materials, they've been laggards over the last couple of months, which you can argue now getting a boost if there is a cycle change here. Romaine?
Let's get right to it here as we kick you off to the close. Jordan Jackson, global market strategist over at JPMorgan Asset Management, joining us right now as stocks hit session lows here, but effectively a fourth straight day where we've seen a rejiggering of positions. Jordan, what do you make of this? Is this just sort of a typical rotation, or are we going to see a more meaningful and I guess a more sustained sell-off?
I think some of this is a bit of a rotation. Right now, I think, though, markets are getting a little bit ahead of themselves in the expectation for rate cuts. You've already got rate markets anticipating about 63 basis points worth of rate reductions for the balance of the year. That's about 2.5 rate cuts. And the Fed is still leaning into the idea that they probably can start cutting rates in September and likely will go again in December. So you're seeing those rate sensitive parts of the market continue to rally. Yeah, I tend to lean a little bit more into kind kind of the narrative of equal weight S&P outperforming the market cap weight over the small cap rally relative to the NASDAQ 100. I think, again, we were talked a long time about small caps needing some rate reprieve, and I think they're getting a little bit ahead of themselves. When we look at the bigger names, the bigger companies, that earnings rebound is expected to materialize over the back half of the year. So I think kind of continue to play in the large cap space and maybe fade this rotation into small caps a bit.
Particularly with the earnings season kicking off and now getting into that phase of the earnings season where we do get those big cap names, those big tech names here, Jordan. Are expectations, in your view, relatively in line with where you think they should be? Or are they too high or too low?
Well, it's interesting because the analyst expectations have continued to move higher, right? And it's not about whether tech earnings are going to be good. It's about whether tech earnings are going to be good enough. And I think that's some of the challenge that we're seeing now where, again, the bar continues to get set higher and higher. Now, over the last couple of quarters, the tech companies have been able to usurp those expectations. But I think it becomes a little bit more challenging. And so I think you're seeing, again, as we talked about, a bit of that rotation and perhaps maybe taking some of the chips off of the table of the big winners and dispersing it to some of the more unloved and underperformers across the rest of the market.
So in looking at what's happening today, for instance, and this tech rout that has been going on for a while, TSMC, for instance, gave a fairly positive update, yet it hasn't helped sentiment for that company or for its peers. What do you think is the bigger driver here behind the tech rout? Is it fallout from geopolitics and this possible White House action against, ship exports, or is it other sectors just simply look more attractive?
I think it's certainly political pressure, right? Sort of the additional regulatory burden that could be put on chip exports or imports coming into the U.S. economy. Certainly some risk there. We also have to recognize that these stocks have come a long way pretty quickly. And I think there's still this sort of excitement, which I think is warranted. But I think, folks are kind of looking at how far things have come, continue to look at valuations, which the big names continue to pressure valuations in an environment where the Fed is going to be very gradual in rate reductions and is certainly not going to get rates back down to zero. I think the valuation argument becomes a little bit more challenging. So I think those are a couple of reasons why sort of tech may be losing a little bit of steam here. But as I mentioned, we still like tech in the long run.
Got it. The FOMC, of course, meets July 31st. There's been talk more and more that the Fed doesn't have a reason not to move in July. Whether it moves in July or it moves later on in September, do you see that providing a lift to some of these mega cap tech names?
Well, if they move in July, I do think this does provide a bit of a lift because that would perhaps lead into maybe 3 rate cuts this year, July, September, and maybe December, and that could provide a bit of a boost to tech. I think, if our base case, though, is September. We think they'd go in September, then again in December. The big debate, right, is again, when we look at earnings and particularly earnings for next year, in an environment which we're seeing inflation come down, is roughly 14% earnings per share growth for next year actually achievable? And I think that's up for some debate. And again, as you talked about, these names have come a long way, and I think investors are kind of spreading the love to other parts of the market right now.
All right, great stuff, Jordan. Jordan Jackson, global market strategist over at JPMorgan Asset Management, helping us kick you off to the close here on this Thursday afternoon. A look ahead to Thursday night and the Republican National Convention in Milwaukee, wrapping up, of course, with the much anticipated primetime speech of former President Donald Trump. A breakdown of what to expect.
Plus, we're watching shares of Domino's. It's falling the most in over a decade. We've got more on that in our stock of the hour.
And media stocks also moving today. We're going to break down the latest news out of Warner Brothers, the latest news out of Apple, and of course, give you that big preview and full coverage of those earnings out of Netflix. All that and more coming up in just a second. This is The Close on Bloomberg.
President Biden is doing just fine, according to his campaign, after testing positive for COVID. News of his illness come as the president continues to fight back against rising pressure from allies to step down from the Democratic ticket. Blackstone president and billionaire Democratic donor John Gray gives us his take.
The president is a good man. He has been a wonderful public servant. And like Speaker Pelosi said, he's gotten the votes in the Democratic primary. This is his decision. But I would hope he considers the really extreme physical toll of this business, of this job, I should say, over the next 4.5 years. And so, again, his call, but it is a very challenging physical job.
Are you looking to support Kamala Harris instead?
I'm going to wait and see what happens here on the Democratic side. I am a Democrat, but I'm going to let the process play out.
If Trump were to take the office after the November election, what would be the biggest change you think to the economy and markets?
Well, I think there would be a couple of them. Regulatory change could be pretty significant, particularly in the area of M&A and antitrust, which has made deal making a bit more challenging. I think on the energy side, the approach towards hydrocarbons and drilling would change pretty significantly. I still think renewables are a key part of the mix. We've got a real need for power. If you think about it in this country, power demand the last decade or so has been flat. It's now projected to be up 40%. Part of that is digital infrastructure. Part of that is this manufacturing resurgence that we've seen. So I think we'll see a change in energy policy. And then you talked about it. We could see a different environment for tariffs.
If you think about the election cycle and what we have seen so far, do you have any concerns as a business leader about unrest in this country?
I have a lot of confidence in this country. We have an incredible Madisonian system. We have so many patriotic people who are Republicans or independents or Democrats. I think most people want to see economic prosperity, want their children to have better lives, want the country to be safe and secure, there to be freedoms. I really believe ultimately, even though there's a lot more friction, social media, I think makes it tougher. I actually think people's goals are similar, and I think we'll find a way to get through this. The events of the last couple of weeks, particularly the assassination attempt, was very disturbing. There's no place for that in our country. And I really think we'll find a way to move forward. I have a lot of confidence in this country, and I know our firm does as well.
Blackstone President and COO John Gray speaking with Arshanali Basak earlier. Now, today is the last day of the Republican National Convention out in Milwaukee, with all eyes looking to the much anticipated primetime speech from Donald Trump. Our Balance of Power co-host, Kailey Leinz, has been in Milwaukee all week, and she joins us now for more on what to expect. And this primetime speech actually gets going at around 8 with a lineup of people designed to kind of get everyone excited. I see Hulk Hogan, I see Tucker Carlson on the lineup.
Yeah, and Dana White scheduled to be one of the last speakers before we hear from the former president himself. Scarlett, read into that what you will about what kind of message about fighting the fight we could get tonight. But of course, this is not just Donald Trump accepting the nomination for the Republican Party for this election cycle. This is also the first speech that Trump will give since surviving that assassination attempt in Pennsylvania last weekend. And he has said that he has rewritten his speech as a result of that. Earlier this week, he described his original speech as a humdinger and says now it's going to be much more about a message of unity. So we will see how disciplined the former president is in that message when he speaks this evening, knowing that he is following his vice presidential selection, J.D. Vance, who accepted that nomination last evening in a speech that was really riddled with populist rhetoric, ideas of America first, being for the working man instead of Wall Street or big business, specifically calling out voters in the key swing states of Wisconsin, Michigan, and Pennsylvania, the Rust Belt. It'll be interesting to see if Donald Trump this evening reaches to voters beyond that kind of part of the country, as that really is what his vice presidential selection seems to have focused on.
I am curious when we talk about this theme of unity here. I mean, are we hearing that same theme out of the other speakers beyond just the president and vice presidential nominees?
In degrees, Romaine, it definitely has the unity message receded a bit as we've gotten more underway in this convention. Of course, in the immediate aftermath of that attempted assassination on Monday, it was quite somber. That unity message was resonating a bit more. And of course, on Tuesday, when former Republican presidential candidate Nikki Haley spoke in the name of unity, you definitely saw it on display. But we also saw it from something different from the likes of Peter Navarro, who spoke at the RNC last evening, literally fresh out of jail. He was released from prison in Miami, flew here to Milwaukee to speak after being, of course, charged in contempt of Congress in relation to the January 6th investigation. The rhetoric we were hearing from him and some others was a bit more inflammatory.
Yeah, I watched that speech. It seemed like kind of a laundry list of grievances and, more importantly, like retribution that he planned to carry out.
Yeah, and the question's going to be, do we hear any of that from Donald Trump this evening, knowing that he has had that kind of rhetoric throughout this campaign about ideas of retribution, though he's come around to saying that his retribution really will be victory. But this idea of being a dictator on day one, some of the more aggressive messaging that we have gotten from Donald Trump, we're waiting to see whether or not that appears in a real way tonight, or if he can maintain the discipline throughout at least the end of this convention, knowing that, of course, throughout this convention, they've been putting a lot of attacks on Joe Biden specifically. And at this point in time, it seems less and less certain that Joe Biden will ultimately be the Democratic nominee. And so it'll be interesting to see how Donald Trump may characterize that as well, if he has some attacks to throw at Vice President Kamala Harris.
All right, Kailey, Leinz, you've got a long night ahead of you alongside Joe Matthew and the rest of the Balance of Power team. We will have full coverage of the Republican National Convention, the main event tonight, with Donald Trump scheduled to speak. Our coverage right here on Bloomberg starts at 5 p.m. New York time. All right, coming up here on The Close, a closer look at some of the big stocks moving on the day and a toast to lower processing fees and higher profitability. We're going to talk to Dan Dolev over at Mizuho about his thoughts on the restaurant software company Toast. That's coming up after the break. This is The Close on Bloomberg. Let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. We're going to start off today with Foot Locker. Morgan Stanley downgrading the stock to underweight. The analyst Alex Stratton publishing a wide-ranging scorecard on U.S. retailers, saying Foot Locker has the, quote, highest risk evaluation D-rating in her retail coverage. She also says the sneaker reseller is at risk of being dragged down further by recent weakness from Nike. Those shares on the day weak as well, down about 6%. Next up, let's take a look at Allstate. BMO Capital upgrading to outperform, with the analyst saying the insurer has wiggle room in its budget to increase ad spending, which in turn should drive growth through 2026. The shares right now up about 3%. I believe that is a fresh record high. All right, and let's take a look at Toast. This is the maker of order processing software for restaurants. There's an upgrade today over at Mizuho to outperform amid opportunity for Toast to cut costs if it renegotiates its credit card fees. Toast, nevertheless, getting caught up in the broader market sell-off today, down about 0.5 percentage point. Those are our top calls here on the day, but we want to stick with that last one on Toast, and pleased to say that the analyst behind that call joining us right now at Bloomberg headquarters. Dan Dolev is senior analyst covering fintech equity research over at Mizuho. Dan, great to see you.
Always a pleasure.
Let's go through the numbers here. When we talk about the credit card processing fees that Toast is on the hook for, if they do get a reduction in that, any meaningful reduction, what does that translate to their bottom line?
It's pure profits, right? So if you think about this, Toast is today, or in a year, they will be the top 5 retailer in America. Give you some perspective, they're going to be doing $200 billion in volumes. One vertical, 100% US focused. Walmart is close to 500 billion. Amazon is in between. So they're up there. They're literally the top 5 retailer. And so the math that we did is we said, look, they're paying interchange like a small rrestaurant, right? But they are the merchant of record. They are the aggregator of all those merchants. So even like 10, 20 basis points or 0.1 or 0.2% go a long way. You can have massive upside to EBITDA by saving money on interchange.
I am curious, though. I mean, how much sway do they have over being able to renegotiate these fees? I guess how much clout do they have to be able to go back to the processors and say, hey, give us a break?
Yeah, and that's really sort of the eureka moment. We never thought they did. But there has been a settlement rejection by a judge recently on Visa and MasterCard. And in the settlement, it says, the judge says that large merchants get substantial, and this is the wording, substantial discounts. This is the first time you can actually get a sense of that a large merchant in the US is getting substantial discounts. So we basically added the dots and said, look, substantial discounts, they're running $200 billion of volumes. They're bigger than some of the retailers that, targets of the world. 100% they have sway. Has to happen.
So you say this will flow right down to the bottom line. Is there a chance for them to pick up market share as a result of this if they are able to negotiate lower fees?
It's more about the savings in terms of profitability that it helps them. They're already 25% of the market. So if you, one of the reasons we like Toast a lot is they are literally a quarter, every fourth restaurant in America now has Toast. It's pretty amazing what they've done. So now we're talking about margin expansion and more products and more software. So this is why we're so excited about this today.
But does that mean that 25% market share is their peak? They can't grow beyond that?
That is what the bears are saying, is that the TAM, so to say, is limited. They could probably go, they could probably do a little more, but they're also expanding internationally now. And there's a chance they'll also get into other verticals. So it's like, I think in restaurants, they're not going to be 80% of the market, but there's so much more room to grow outside the US.
What's the timeline for this?
So they've been growing so fast. I don't think it's been like, if you go back like a year or 2 years ago, they were like in the, $50 billion thing. Now in a year, they're going to be $200 billion. If you go back to their presentations, management has specifically said they have a whole team focused on lowering processing costs. So I think it's sooner rather than later. I think it's 6 to 12 months. You could start seeing
2025 story.
Yeah, 100%.
All right, Dan, always great to talk to you. Dan Dolev over at Mizuho. I have to leave it there. A closer look at Toast. Shares on the back foot today amid a broader sell-off, but seeing a spike in some individual names right now, including Broadcom. Shares higher by about 1% on the back of a report by the information that OpenAI has been talking to Broadcom about developing a new AI chip. We don't have any more details other than that, but again, this is reporting coming out of the information. The shares, which had been in the red, spiking by about 1%. We should also point out another stock also moving higher right now is Smartsheet. Scarlett, up about 4% right now. This on the back of a report by Reuters that Catalyst Partners has been fielding takeover interest for the company. Of course, Catalyst, the big fund founded by Frank Quattrone here. Again, not a lot of details on who's kicking the tires here, but that would be a big deal as well.
Yeah, well, we know that private equity has a lot of money to put to work right now. It's a matter of whether they can exit some of their current investments and do anything and monetize all of that. But yeah, Smartsheet getting buyout interest from private equity firms, according to Reuters. We did not get a response from Smartsheet or Catalyst for their requests for comment on this report.
Yeah, interesting stuff too, particularly on a down day. You see what really moves the market, which is still M&A.
Always. Yeah. All right, coming up, are you still watching Netflix? If you're a Netflix investor, you'll be on the lookout for key data points in this afternoon's quarterly report. We'll preview what to expect. Really?
Yeah.
Why?
Because I don't really watch it anymore.
But you still have it, though.
Yeah. That's
Other members of your family watch.
No, they don't.
Really?
We're like a Max household now.
Interesting.
Yeah, I don't know.
This is The Close on Bloomberg.
You didn't need to know that, but just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Scarlett Fu. It is a down day for the overall stock market. We're seeing indexes near session lows, but Warner Brothers is gaining after the FT reported the media giant considering separating its streaming and studio businesses from legacy TV. Yeah, just over 2 years after they combined everything with Discovery.
Yeah, I'm absolutely fascinated by this. In case you know, I might have a personal interest in this, in the future of linear television. But it's kind of interesting too, because this whole mashup was supposed to solve the problems, and that was what, 2022?
Yes.
When that deal, at least when it was completed or something?
Yes.
The idea that 2 years later, I understand they kind of have different leadership and lots going on, but I don't know, this seems like a huge U-turn for
the macro environment changed completely.
Yeah.
So, obviously reducing their borrowing costs has been mission number one for David Zaslav, who heads up the company. But yeah, this is kind of curious because you're basically separating assets into the past and into the future, right?
Yeah, and the idea that the digital side will be its own thing. In theory, that has more value than the linear and more traditional TV networks. And I was rambling before the break about how we've kind of become, I mean, really, HBO Max has kind of become the dominant streaming service in our household. Like, we still pay for all the others because we're suckers like everyone else.
Or you're watching Dr. Pimple Popper?
But we very, very rarely click on Netflix, very rarely click on Hulu, and Amazon. I don't even know what the purpose of Amazon Prime is these days. It's basically all HBO Max.
Get you free shipping.
They should be like pigs in slop right now, just loving this.
Yeah, well, I mean, You know what? There's a lot of speculation, and it could be tied to the fact that there might be a new administration in November. And so there's a lot of interest in talking through what kind of consolidation might be taking place in the industry.
Yeah.
That as well.
Yeah.
All right. We're also watching Apple, by the way, after Bloomberg learned that the company is looking to license more films from major Hollywood studios like Warner Brothers, for instance, to help bolster the Apple Plus streaming service, which you said you do not have, right?
No, that is actually probably the one we don't have. And I think we did like one of those trials, when you get a new iPhone, you got to try it. And it was it was fine, But the breadth of content isn't there. And like with HBO Max, it's such mindless content too. You mentioned Pimple Popper. My wife watches all those Love, whatever, 90 Day Fiance, and she could just watch that for like 12 hours straight. It's kind of like, just draws you in.
Yeah, it does.
Yeah.
It sucks you into an alternate universe.
They really did Ricky wrong.
I had never thought I would hear the day when you opine on this. All right, speaking of all these different streaming services, we're less than half an hour away from the start of tech earnings. Yes, we are, when Netflix does report at 4 p.m. Another solid quarter could finally allow Netflix shares to regain their all-time high since 2021 and fully recover from a rout in 2022. Joining us now on what she's looking for is Magalie Grossheim. She is senior analyst covering media and consumer health and services at M Science. Magalie, thank you so much for joining us. Everyone's talking about how the problems from 2022 are over, and this move to crack down on password sharing is driving Netflix in the right direction. Are expectations maybe a little too high going into this report?
We actually think they're poised to do quite well this quarter, heading into the print that we'll see here pretty soon. And really, we think so we're expecting about 7.5 million paid net adds for them globally. And that's above where sell-side expectations are, about 4.8 million. We have heard from investors that their expectations are kind of in the 8 to 9 million range, so a little bit above, where our estimates are at. And we do think they're doing quite well. A couple of the drivers behind that, one of them is the continued tailwinds from paid sharing. We really think they're still getting juice from that program. They did launch that, back for a few of the guinea pig markets in February 2023, and then the whole globe in May of last year, late May. And so we're still really seeing, a pretty strong net add cadence from them, even as we're lapping that 1 year mark of the paid sharing program. And then additionally, we think that, there's a few other drivers, such as their content slate, which has been quite well. Mm-hmm. It's not always the case that you can see discernible net ad bumps around the timing of content releases for Netflix or other streamers. And we actually do see that at M Science. We use a few different transaction data sets to track subscriber additions. And you can see around a few of the content releases, such as Baby Reindeer, Bridgerton Season 3, specifically Part 1, the Asunta case in Spain, and then a few local content releases in India that we saw clear drivers as well.
I'm glad you bring up Bridgerton and Baby Reindeer, because a lot of people are saying the second quarter typically is a seasonally weak period for Netflix, and it has to continue to deliver these releases that keep Romain's family from canceling their subscription. In terms of content and the pipeline, what is there that'll keep people going and perhaps pay for the more valuable advertising supported tier?
Yeah, we've actually got a lot coming up. Q3 has a pretty decent content slate as well. We've got another season of Cobra Kai, Umbrella Academy. They've got Emily in Paris, new season coming out. And then even as we look later in the year, there's another season of Squid Games, which was obviously a really blockbuster hit for them previously. And then heading into Christmas, they've got, the live NFL games that they just did a deal on recently. Yeah. Other live events too, we think are helping them, and that's proven to do pretty well so far since they launched those live events. I'm
curious as to how much further they push into that live event space. I mean, we talk about the slate of scripted content, certainly not as robust as what we saw in the past, and the new head of programming has made it clear they're going to be more selective. But on live programming, this seems like an opportunity, or at least one that Reed Hastings himself has talked about a lot on these conference calls, as kind of being the future of this company.
Potentially, yeah. They've been cautious in terms of how they speak to live events regarding sports, just because, that the rate that they're going to pay for that is quite a lot, and I think they do want to stick to that 17 billion run rate on content spend. So I think they are, somewhat cautious on the topic of live sports, but for other avenues, they've seemed to do pretty well. They've got, the Joe Rogan event coming up. The Tom Brady roast was a big hit as well. So definitely looking forward to see what they'll say on that today.
Yeah, that roast, it was like marginally funny, but I understand why it did well. I am curious about the growth for this company. I know they're trying to steer us away from paying attention to subscriber growth and some of those numbers, but we do know that we had seen a lot of softness overseas and some of the promise of this company being able to expand into outside of U.S. markets didn't necessarily materialize in the same way. Maybe they got some of the subscribers, but they didn't necessarily get the revenue out of it, or vice versa here. Do you still see a longer term strategy for them to have a bigger footprint overseas?
We do, yes. One thing that we think is potentially going to play out over the next year, we think that they launched paid sharing a little bit more gradually in certain APAC and LATAM markets than they did in some of the more mature markets in Western Europe and the US. So we think the juice and kind of that tail left in the paid sharing program might be a longer runway for APAC and LATAM. If we go back pre-paid sharing as well, so kind of the year ago quarter and Q1 of last year, or even before that, a lot of the net adds that they were getting were coming from APAC, specifically APAC. LATAM did well also. And you saw that mix shift happen before they launched paid sharing. So we'll also be looking out today on what they're going to say kind of on that tail left in the paid sharing program. And if we are to start to see those more mature markets slow down a bit as that unwinds, are you going to start to see this mix shift towards lower ARPU markets in APAC and LATAM, which could potentially be a challenge on the ARM side?
All right, great stuff, Magalie. Always smart. Magalie Grossheim, senior analyst over at M Science. A nice preview of the results that we expect to get later tonight out of Netflix after the bell, Scarlett. And it's interesting on the content side. I mean, like some of these new programs I know did okay, although I think, as you pointed out, they didn't necessarily get the same amount of Emmy nominations as some of their competitors. And then that Baby Reindeer, which totally was not what I expected. It was not about babies or reindeers, and a lot darker than I would have preferred to have sat through. But
I agree. And I think the Emmy topic is a big consideration here, because they obviously want to create programming for prestige. But if you're not getting the Emmy nominations, it's just something that's on in the background. But does it keep people there when they are looking at their budget and thinking, you know what, I don't need to subscribe to 5 different streamers?
I am also curious about their strategy on trying to push more people onto that ad tier platform. I don't know if you've seen some of these posts on social media, people who are paying for the ad-free version, but when they're logging in, they're getting a message asking them to subscribe and switch.
So it's
to
like,
the
I've already made my
version.
decision,
so
bother me.
So it's kind of like maybe they're feeling like maybe that's a better way to go for them. Anyway, we'll have full coverage, of course, of Netflix earnings expected to post after the bell tonight, so stick with us. Before we get to those bells, though, we have to talk about the biggest mover of the day. Biggest decliner in the S&P 500 is Domino's. The worst day for that stock since 2008. We're going to explain when we come back. It's our stock of the hour. This is The Close on Bloomberg. All right, it's time now for our stock of the hour. A closer look at Domino's, the pizza chain, sinking the most since at least 2008 after unexpectedly suspending its store growth target. A signal here that some of its efforts to draw in customers with discounts and product launches not quite paying off just yet. Abigail Doolittle joining us for more on the stock, down 14%. A comp sales miss and some concerns as well about their international growth. What's going on here?
Yeah, it's more about the international growth, because the U.S., they did miss slightly, but it was basically fine. China was actually good. But what is really going on here is one of their international partners, one of their master franchisees, basically sold them a good of bills. And in a good way, it impacted their long-term guidance last December. Now, however, not so much, because the same partner is saying that they're going to probably close up to 80 stores, many of them in Japan and France. And then they have a lot of other of these partners, so there could be some fear that could play out again. But when you think about the revenue for this company, it's going to be on the unit growth, or it's going to be same-store sales. Unit growth is seen as the easier part to get to grow. But now the fact that they're suspending it, saying that they don't have clarity, it's definitely worrisome.
Yeah, we also see shares of Papa John's International falling in the wake of this as well. Why are you smiling?
There's a lot going on in this head of mine, Scarlett. You don't want to know.
We smile a lot on Stock of the Hour.
I was an only child. I had to entertain myself. This is a byproduct of that.
I look at the chart for Domino's Pizza, and it is pretty remarkable over the past 2 years. It's gone from 285 in May of 2023 to as high as 533 in June of 2024. So a lot of this feels like it had gone up so much that, the first bit of disappointing news is going to generate a very violent reaction in the stock.
You make an excellent point, and this story was so interesting to me that I actually, for once, didn't look at the chart. And when I pulled it up as you were saying this before we went to air, I mean, this chart looks brutal, actually. Today's gap down below the 200-day moving average. It looks like it's going to go right back to last year's lows, around 300. What goes up must come down. And a piece of it was what you're talking about with Uber. Another piece of it was this long-term guidance. Mm-hmm. Now, when you put this together with the overall feeling around restaurants right now, it's not so great. Casual is down 1%. Fast food takeaway is basically flat to up slightly. So there's a little bit of a sentiment problem here. So when you have this fast rising stock hitting, a major partner, not, delivering in the way, and then also a little bit of weakness, it creates this possible big correction.
All right.
Actually, it is a real correction today.
Yeah, absolutely.
But could deepen.
Thank you so much. By the way, the New York style pizza not doing too well for Domino's.
The New York style pizza?
Yeah, thin crust.
I don't understand. Okay, I don't want to.
They said big triangle slices that you can then fold up and eat.
Oh, really?
Like John Travolta in Saturday Night Fever. It's a Thursday. This is the close.
Analyst expectations have continued to move higher, right? And it's not about whether tech earnings are going to be good. It's about whether tech earnings are going to be good enough. And I think that's some of the challenge that we're seeing now where, again, the bar continues to get set higher and higher. Now, over the last couple of quarters, the tech companies have been able to usurp those expectations. But I think it becomes a little bit more challenging.
Earnings season in full swing. Jordan Jackson there helping us kick you off to the close. A commentary here about those earnings and a big one coming after the bell tonight out of Netflix on a day where stocks remain on the back foot, at least as a group.
Yeah, and it kind of sets the tone for what's to come, especially with the rest of big tech reporting in the next 2 weeks or so. When you look at what's going on over on the market, there's a lot of red on that screen. But notably, the Russell 2000 is underperforming the big cap stocks, and that's been a change from what we saw since last Thursday when the CPI report came out and really gave everyone this the go-ahead to go move forward into small cap companies with the idea that the Fed is not that far away from cutting interest rates.
And it's interesting, too, to kind of figure out exactly what is causing this sort of maybe rethink. Is it about the macro? Is it about the corporate fundamentals? Is it about geopolitics or maybe some combination of it all? Linda Duessel joining us right now, senior equity strategist over at Federated Hermes to help us count you down to those closing bells. Those bells just about 8.5 minutes away. And Linda, I mean, maybe you can help make sense of this, because I think when we looked at that rotation, and it was a true rotation, it kind of started last week, continued through the first couple days of this week, folks piling into small caps, out of large cap, big tech. That trade obviously on pause for today, but I'm wondering what you thought was behind that rotation to begin with.
Well, yeah, sure. And thank you both for having me back on your program. It's been just a very powerful rotation out of these big names. And I think that the guest that you just had on suggesting that, anytime you get into the new earnings season, you have to wonder how those big tech names that pretty much everybody owns will announce earnings, because that could be a big move down in stocks that pretty much everybody owns. And so they're at the ready maybe to take profits when there's some whiff of possibility that small caps could enjoy a Fed rate cut, extremely underowned, and the last 5-day moves, not today, was like a brand new record in terms of small caps moving as versus the S&P 500. At minimum, a breath should be taken there, but much of what my research suggests is that there was a lot of short covering going on as well.
Yeah, the short interest on the Russell was pretty high, as well as on the S&P 400. I am curious, Linda, when you look at, though, the run-up in the market, overall in the market that we saw over the last few months here, heading into an earnings season now where expectations have shifted, and as Jordan Jackson was saying at the start of the program, at least in his view, analyst expectations are probably much more elevated than where they were the last couple of quarters. How consequential do you think this next couple of weeks of earnings are going to be for the market?
Well, and it's interesting, and you just spoke about Domino's and some of the names that come out, whether they came out very strong. Even today, and D.R. Horton was up big time today, just maybe disappointing a little bit or surprising a little bit, and the big moves that these make on an individual day, it's not a healthy thing. In my view, there's too much trigger happiness going on here. And so when you dive into earnings season, anybody's fair game for going up hard or going down hard. So it could be a volatile several weeks here.
Yeah, it could be. And I guess part of my question, part of what determines how this shakes out is how people were positioned heading into earnings season. Normally, we know that everyone was very long big tech, but in the last couple of days, that's been scrambled with this rotation into small caps. So that being the case, what does the positioning look like as we get into the meat of earnings season?
Well, I think still that the small cap stocks, and even I'd give a shout out to the defensive names, those high quality dividend defensive names have had some really good. They had a great week last week, had some really good days already this week. They have in common what small caps do, which is that they've been left for dead for quite a while. So if there were any catch up to do, it would be a lot more than where we are now. And some of the most bullish people that I read, sources that I read, suggest if small caps are up, 10% or more, they could go up 50% to the extent that we believe, with a 100% certainty that the Fed's going to start cutting in September and a 75% certainty that Trump will win again and animal spirits can be unleashed. This could be powerful even in through the earnings season, which is expected to deliver, I believe, on average about 10% growth. That would be a good quarter, and it's just a reflection of what we thought we read from corporate managements last time around.
So you mentioned politics and this idea that Trump could win a second term of presidency. There's a headline here from ABC that President Biden absolutely is more open to hearing calls to exit the race in November. We definitely saw a lot of positioning on this idea that Trump would win a second term. Energy stocks, for instance, the second best performer since last Thursday. Going forward, do you see a lot of movement when it comes to politically sensitive sectors like that, or is that going to be on pause right now as we wait for things to shake out?
I think that we maybe should expect a volatile next number of months, not to stop, but to be volatile based on whatever we hear. We all know that this is a particularly unusual election season. As far as I know, there are 16 weeks to go before Election Day. And that supposedly is a lifetime in politics. So it could very well be that people are chasing these names because now they're 75% sure that Trump's going to win. And so we bid up financials and we bid up energy shares. But that could also be, these are exceedingly cheap. And you'd say the same thing can be said for energy shares, exceedingly inexpensive for the earnings that they have. Given that you're buying small company stocks that are profitable, of course, about a third are not.
All right, Linda, going to have to leave it there. Always great to talk to you. Linda Duessel there, Senior Equity Strategist at Federated Hermes, helping us count you down to those closing bells. Just about 3 minutes until we get there, Scarlett. Obviously, we have a lot potentially coming up after the bell with Netflix earnings on tap here. But we need to kind of walk through some of the numbers today because it looked like we were going to get a little bit of a rebound today, particularly in that tech trade. That faded pretty quickly early in the session. And while we're off the lows of the day, still headed for some pretty significant losses here with the Dow down 1%, the S&P and NASDAQ each down roughly almost 1% on the day. And the Russell, as you've been pointing out, actually your laggard for the first time in about 6 sessions, down about 1.8%.
Yeah, so I think key to all of this is how the chip makers are doing, because yesterday was a brutal day for those chip companies on this idea that President Biden would be tougher with chip exports. It's a real mixed bag today. And this is even after TSMC had fairly decent results, raising this revenue forecast. And
it gets to this idea about this being an idiosyncratic market. We talk about a Domino's Pizza being the worst performer in the S&P 500 on an idiosyncratic story, and then something something like D.R. Horton rallying more than 10% to a fresh record high on the idiosyncratic story here. And maybe that ends up being the narrative for this earnings season, which, of course, we're going to get into what I think is the heart of it. I know everyone thinks it's the big banks, but I think it's the big tech companies.
Well, it is now, big tech.
Yeah, absolutely. Here, stick with us. We are moving closer to those closing bells. You see the clock flipping. Full market coverage coming up right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Scarlett Fu, taking you through the closing bell. It's our global simulcast, starting now with Carol Massar and Tim Stenovic joining us from the radio booth as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube, here on this Thursday afternoon. Alex Steele taking a well-deserved day off, and she's missing a lot of action today.
Yeah.
Another sell-off here, though it looked like we were going to get a rebound earlier in the day, Carol. I'm not sure what you said or did, but stocks right now back to lows on the day.
I did nothing, anybody, or everybody. Listen, though, I'm looking at pretty much broad-based selling because you've got most of the industry groups in the S&P 500 lower today. So you're seeing it really broad-based. It's not, for a while I felt like we had small caps coming back, but even they're having some struggles.
Yeah, I think that's what's really notable about today is that it's not this rotation trade out of mega cap tech and big names and into small caps. We're actually seeing the Russell 2000 underperform the other major indices today, Scarlett.
Yeah, within the Russell 2000, all 11 industry groups are down. The best performers are utilities. They're losing 0.9%. But within the S&P 500, interestingly, energy and utilities are holding up better than the others. Utilities unchanged. Energy stocks up by 1/3%.
And that's been the story really over the last few days. So we are seeing somewhat of a macro story to this and maybe an interest rate story to be a little bit more specific. We should point out we get some big earnings after the bell, including out of Western Alliance and Intuitive Surgical.
Oh, is that what? It's interesting that you say those names, Romaine. There's also a company you stream
a little known company,
services.
Little known.
Yeah.
Right?
All right, Netflix results are imminent here. Let's get you through the numbers before those results hit here. Red across the screen for all of the major indices. The Dow Jones Industrial Average down about 1.3% here on the day. The S&P down about 0.8% on the day. The Nasdaq Composite is going to finish lower by 0.7%, and the Russell 2000 down by 1.9. Netflix earnings crossing the wire right now. Let's take it, guys, here. Revenue in the most recent quarter coming in at about $9.56 billion, a slight beat over what the street was looking for. EPS at $4.88 a share, a slight beat over what the street was looking for, 4.74. And here are your streaming numbers here. 2Q streaming paid net change, 8 million subscribers added. The street was looking for roughly about 4.9. And the company also guiding somewhat higher here for the third quarter, though it does look like the revenue number might be at just a tad light. 9.7. Street was looking for about 9.8 billion in revenue.
Yeah, but what's interesting is that second quarter streaming paid net change, a big beat, as we said, 8.05 million versus the estimate. But having said that, the company also says it sees third quarter net adds lower versus a year ago. You are seeing the stock bouncing around big time, Scarlett, in the after hours. But right now we're down about 3%. I'm looking at it in real time, down about 3% here.
When it comes to free cash flow, Netflix still sees full year free cash flow at about $6 billion. Analysts were expecting something more at about $6.6 billion as well. Netflix may be making some changes to its debt burden. It's going to refinance $1.8 billion of maturing debt in the next 12 months. It took on a lot of that debt, of course, to pay for the original content that it's been pumping out.
You know what's interesting is everybody says that the streaming paid net change, subscriber numbers is what everybody cares about. And this came in almost double what analysts expected, at least for the current, for the previous quarter, at 8.05 million versus estimates of 4.87 million. Yet third quarter revenue coming in a bit light, and perhaps that's why we're seeing shares down right now by 4.8%.
But I'm curious, so with the boost in that revenue forecast for the full year, is that maybe a testament to some of the changes that they made to with the ad tier and everything else?
Could very well be. That's all things that we'll need to get from the company when they host their earnings call. Let's go over now to Bloomberg Technology co-host Ed Ludlow, who is standing by. He's been looking at the numbers. Ed, what do you see?
Yeah, I think a lot of emphasis on the current period. You know, when you saw that beat in the second quarter, 8.05 million new subs, you think, wow, the stock surely is going to go up. But they're kind of holding our hand towards the future. Remember that starting next year, they won't give us those net new subs numbers at all. And for the market, that's been a concern about the long-term growth narrative. There are some factors at play, including FX as a factor in the current period. We emphasize so much how they perform in America, but in other emerging markets, in Latin America in particular, they talk about markets like Argentina, local inflation there, currency impacts there being a factor. I guess the story, even though the stock's down 6% after hours, is the ad-supported tier is working and the password crackdown has worked in the quarter gone. Maybe the market just doesn't see a story of what's going to drive growth from this point onward.
Well, what maybe is going to drive it is some of the new genres it's going into in terms of content. I'm thinking about NFL, right? There's going to be 2 live NFL Christmas games. There are also WWE. These are things that they're rolling out in terms of content that maybe bring in new subscribers, new eyeballs. So they obviously have to spend for these things. That's an important part of the Netflix story.
You don't want to talk about the hot dog eating competition? I thought that's where you were going to go with that. I mean, in the quarter just gone, one of the big factors they call out was the roast of Tom Brady, which was a live event. And again, it's really interesting to see this negative reaction. Mm-hmm. It's astonishing what they did in that quarter. They account for 8% in the most recent month of the total streaming market, almost double the percentage value of all their competitors in that streaming market. And they have a pipeline of things to come, like you say. So I don't know, maybe the street, even though they weren't so expectant on the subscriber growth in the fiscal second, maybe they were hopeful about somewhere else. And I think I heard you, Scarlett, talk about the debt burden or debt situation that they're rethinking as well. They've been calling on the market to say, judge us by traditional financial metrics, not by our subscriber base. Here's some judgment for you.
Yeah, and that judgment's going to get a little bit harder. It's interesting, too, when we're going through their strategy, at least as what they laid out in their shareholder letter. They make a very explicit lob here at some of the bundling that we've seen in the streaming space by some of the, I guess, more traditional providers here, and basically saying they're not participating in that. They don't actually see a need to have Netflix bundled with other streamers like Disney Plus or Max because, as it says at Ludlow, Netflix already operates as a go-to destination for entertainment thanks to the breadth and variety of their slate. Is that slate going to hold up?
Yeah, I think that people seem to be willing to take the slate with ad support, right? Look at the ad growth in the quarter gone, 34% growth in the ad-supported tier quarter on quarter, but all the new signups, half of them were in the ad-supported tier in the quarter just gone. They don't mind ads, and one success that the bundlers have had is to say, okay, pay us a little bit more, get maybe like ESPN, Hulu, Disney Plus, but with no ads. You're getting value there, and Netflix has resisted the urge. One area that it is trying to not bundle but give more value is also in video games. You know, there's a clear commitment here to bring out video games with more cadence tied to some of their key titles.
When are they going to do that, Ed? I mean, it says in the release they're going to plan to launch one title a month, but it seems like most of the titles that I've seen are like whack. Let's just say it. I mean, they're just not very good. Yeah.
And they're also mobile focused, right? So if you go onto your smart TV and look at Netflix, there's no reference to game at all. They had the June refresh on that. When I go on my smartphone and I look at Netflix, there are loads of sort of mobile games that I could get anywhere else through the iOS App Store or otherwise.
Hey, Ed, for years, Netflix talked about basically anything that anyone did with their time other than stream Netflix was competition. Now they're actually getting a little more concentrated in the letter and talking about what their key to growth is, the 80% of TV time that people spend not watching Netflix. Yes, some of that is streaming, but also some of that is broadcast and some of that linear. And to that end, the company said in its letter that it's redesigning that landing page for discovery, for content, when people go to Netflix on their smart TVs. I mean, is that the golden egg that Netflix needs to figure out? That it has to give you exactly what you want to watch, when you want to watch it, and that's going to keep you there?
They've also talked historically, though, that in the battle of eyeballs, it's the TikToks and the other social platforms that they feel they're competing against, not Disney. And the market's not really ever paid it that much credence. They want to have a good product. It's not directly Netflix news, but the other big story today, of course, was, according to sources, Apple is going to spend more on backfilling its catalog.
Right.
And Netflix, while we can talk about the cadence at which they bring new content, video or gaming otherwise, they do have a decent historic catalog as well. Make it nice to look at. I think that might be the logic.
All right. Well, Ed Ludlow, thank you so much. We're going to continue to certainly break down these earnings results. Just a quick rehash, folks. Netflix extending its lead over streaming competition, adding 8.05 million customers in the second quarter, so crushing even its own forecast. But the stock has been bouncing around. It's still down, Scarlett, about 1.5% here in the aftermarket, off its lows, though.
Yeah. I mean, one thing that has become really clear from all the analyst notes is that, and the company itself, is that this ad-supported tier is very valuable because they can make more money on it. But we note that the U.S. viewers generate more of that revenue than international viewers. So at what point do they tap out on U.S. viewers who pay for the ad-supported tier versus having to find that growth in the international markets?
And they do talk about in the letter, we don't expect advertising to be a primary driver of our revenue growth in 2024 or 2025. So they talk about some near-term challenges. So we're getting some more specifics, if it will, in terms of the advertising impact and certainly some of the build out here on what it means really for top and bottom line growth. All right, guys, that's a wrap. Continuing to watch Netflix down about 1.7% here in the aftermarket. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you same time, same place tomorrow for the closing bell.
All right, let's keep our coverage going right here on Bloomberg Television. A closer look at those earnings out of Netflix here. A beat in the most recent quarter, a raise in guidance for the future here, but the shares showing some weakness here in after hours trading. Joining us right now is Senior Portfolio Manager over at Synovus Trust, Dan Morgan, to help us break down these results. Not necessarily bad, but you see the market reaction here, Dan. What exactly were you expecting to get out of this, and did you see it?
Well, I mean, I thought it was a stellar number. I mean, as you talked about before, I mean, coming in over 8 million new subs when, you know, the consensus was at 4.8 million. Even the whisper numbers that I saw were kind of like 6.5 million. So that's a huge beat. A beat on revenues, a beat on earnings per share. You know, the only thing I think of, Scarlett and Romaine, with the sell-off is, you know, let's face reality. Netflix stock is up 40% year to date. It's been one of the best performers in the tech space. And, you may just be getting a little bit of that old, you know, buy on the rumor, sell on the good news, because it looked like a strong beat, you know, just on the faceline numbers. I don't see anything that I can point to that's negative that would be a reason for the stock to trade down.
Tim was telling us earlier how Netflix used to say its biggest competition was sleeping, but now it's pointing out that its biggest competition is people watching other forms of television and not Netflix. That being the case, this is an election year, and all the drama that's taking place is on the broadcast channels or on cable television. It's not on Netflix. Netflix's escapism from the volatility of politics.
Yeah.
Is that going to be something that hurts Netflix down the road as this election season gets more and more unconventional?
Well, that's a good point. And, you know, if you look at the most recent data that came out in terms of streaming services, the number 1 and 2 were Netflix and YouTube. And this may favor YouTube a little bit more than it would favor Netflix, as you just mentioned, Scarlett, coming into this political season, because obviously you can dial into your YouTube and watch, you know, the convention or whatever you want to watch. So where Netflix is, as you mentioned, escapism effect. So I'm wondering if that market share data may change a little bit. The other streamers all kind of carve out kind of single-digit market share. You look at Hulu and Disney Plus and all these different things are kind of this, you know, mid-single digit. So they're the two top players. But in this environment going forward, I think you're right. It would favor a company like Broadcast Channel or also in terms of potentially like a YouTube.
Well, I'm glad you brought up YouTube, because even in the shareholder letter, I mean, Netflix kind of points out, you know, their market share relative to their competitors, and pretty much everyone is behind them with the exception of YouTube, which continues to dominate. And I think a lot of folks who certainly have kids of a certain age know that YouTube is probably much more of a must-see TV for a lot of folks out there than Netflix, Hulu, or certainly the linear TV networks. Should Netflix maybe have its eyes much more on YouTube than worrying about Hulu or Disney and the others?
Well, that's a good point, Romaine, but they're different content, right? YouTube has a different format. You know, you can watch some event that occurred, you know, yesterday in that effect. They don't have the polished content that you would have on a Netflix. I still think they would still be thought of as competing against the Disneys and the HBOs and the Hulas, opposed to, let's say, trying to come out with the type of content that YouTube does. It's just kind of they're much different animals, no doubt about that.
Well, they're much different animals. They also have much different cost structures, too. And one of the bugaboos, I think, for investors has been that, Netflix produces some great content, but that comes at a huge price tag. And I know they've tried to rein that in a little bit, kind of put a cap on what they're willing to spend here. Are you comfortable with that run rate, at least of what they've disclosed publicly?
It's interesting, Romaine, when I looked at coming in this quarter in terms of the expectations for fiscal year 2024, if you look at their SCO or their streaming contribution obligation, it's projected to be about $23.5 billion. It's expected to be up about 6.5% from a year ago. So, free cash flow this year expectations are about $6.5 billion. So they've done a better job to kind of control the costs, like you said, Romaine, in terms of content. It used to be just spend money everywhere, right? Mm-hmm. Get unlimited number of subscribers and don't worry about it. And now they're actually, paying attention to making sure their cash flow is positive and trying to kind of rein in that contribution cost. But, you live and die by your content, right? So you've got to keep spending money. But you're right, Romaine, you don't want to go too crazy and have to issue debt, which is what they were doing before, and have negative free cash flow. Yeah. So you have to find that balance.
Absolutely. But, they have more willing partnerships now from other companies that are willing to license their content. For a while, everyone was hoarding it so that they can build out their own streaming service. We know that Netflix spends on content, but what about for the other things that we know the rest of the tech companies are spending on, which is building out their AI infrastructure? When it comes to CapEx, does Netflix take part in any of what Alphabet is doing or what Amazon is doing, paying for AI infrastructure, investing in that AI infrastructure?
You bring up a good point, Scarlett, which is, we think about, we're getting into the reporting season, right? We're going to do Alphabet's coming out on Tuesday, and then we have Microsoft, and the week after that we have Amazon, and we have Apple, and all these big, companies. Microsoft is coming down the corner too. And, one of the things that we're always concerned about with these companies, we look at, well, how much are you spending on CapEx related to building out this huge AI initiative that everybody wants to see from you? And one of the benefits going into this report for Netflix was they don't seem to be under that same pressure, right? Mm-hmm. They don't have to keep building out and spending, $40-50 billion next year to kind of build out an AI presence with their CapEx. So that was one of the things that was supposed to help them. Be honest with you, Romaine and Scarlett, AI is in everything right now. So I wouldn't be surprised if during the conference call somehow it's dropped that we have a new AI tool that's used to, help us with our advertising, or something to that effect. But they definitely don't have the huge amount of costs that these other FANG stocks are going to have as we get into this next coming reporting season.
They're more likely to have a show, a mini-series on the AI boom in markets, and that would be very meta, by the way. From where you sit, Dan, when do you view Netflix as a media company versus a tech company? Of course, we know Netflix competes against Warner Brothers Discovery, Disney, Comcast for subscribers, as its business side. But as an investment, it competes kind of against the big tech companies, doesn't it?
Scarlett, I still look at them as a media company. If you look at their current multiple, we're trading right now at about 35 times this year's earnings estimate fiscal year. I don't know if you guys remember, Romaine and Scarlett, it used to trade like Amazon, right? It was a 65, 70 multiple, and everybody thought of them as this FANG stock. And now they're really trading in a multiple more similar to what we would see in the media space and what we would see coming from, let's say, an NVIDIA or some of these other huge mega cap tech stocks that are just trading at huge market multiples.
All right, well said. Daniel Morgan, a senior portfolio manager at Synovus Trust, giving us his take on Netflix's results. And of course, we are awaiting the conference call where they will perhaps address some of the more pressing issues. One big question, Romaine, that comes to mind, especially for Netflix, is we don't really know the size of its advertising supported tier.
No, and of course, I scoured through the press release. That was the first thing I was hoping they would disclose. And of course, they're not willing to disclose that just yet. But it gets to the idea, too, and just to pick up on Dan's last point there, this is kind of the maturation of this company, right? And we've seen this with our big tech companies. Apple was a perfect encapsulation of that, where you switch from being kind of the ultimate growth stock to just kind of being a big cash generator. It might be boring, but
a steady company.
But a steady, and maybe that's all they really need right now. Remember, there was so much criticism lobbed at Apple, and every quarter they continue to surprise to a certain degree every quarter
and
to
I
the
think
upside.
That's encapsulated in the way they talk about their competition. It's we want to be more of your TV time as opposed to we're competing against sleep.
Yeah, but they got to do better. And I I understand Dan's point about YouTube and that's it's different content, but that's stealing a lot of eyeballs. Of course, video game strategy has not picked up the way they thought it would be. We'll see where the live events, and particularly live sports, and the costs associated with that does it as well. All right.
We have a lot more coming up.
Yeah, we're
going to talk more about Netflix.
Are we going to talk more about like what's? I mean, you've seen Bridgerton.
Yes.
Did you have you heard of Under Paris?
No. What is that?
It's about sharks. Apparently, they're under Paris.
Under Paris?
Yes.
It's a Netflix series?
They say in their press release. They say it's one of the most watched on their.
I've never heard of this.
Right
It doesn't show up in the algorithm for me.
It's our buzzy horror movie from France. It's now number 3 on our most popular non-English film list.
Sharks Under Paris?
1 million views. Scarlett.
Just in time for the Olympics.
This is The Close on Bloomberg.
Season is here.
We're skating into another earnings season.
The expectation for earnings going forward are quite high.
Bloomberg is first to break the numbers.
Adobe earnings crossing earnings out of Broadcom.
JPMorgan, we get Citigroup, we get Wells Fargo.
There is something for everybody.
With the smartest insights.
Now banks have earnings power.
There's a resilience in the bigger cap companies.
We're not talking about a collapse in earnings for technology.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Welcome back. Keeping an eye on shares of Netflix oscillating here in after hours trading. The results of their latest quarter are out, a beat on the top and the bottom line. The guidance, at least on the revenue side, guiding to the upside, but investors wanted just a little bit more. Chris Palmeri joining us right now, who helps cover this for us out there on the West Coast. And I want to just talk about viewership and engagement overall, because I know we obsess over these numbers. But Netflix itself, Chris, in the news release, they kind of point out all their competitors, where they sort of rank in terms of market share here. No surprise, Netflix more or less at the top, save for the exception of YouTube. Talk to us about just overall trends right now in streaming viewership habits. Is that still going up in aggregate?
It is. In fact, streaming just hit a record share of overall TV viewing of 40% recently, and there's no doubt about it. Netflix is gaining share. 277 million subscribers around the world, huge number. Their point was that some of the other folks are spending a lot of money on programming, but aren't getting as many viewers as they are. There's no question. Netflix shows they become buzzy. They get talked about. They don't get the same level of promotion that a big movie does in Hollywood, let's say, but people find it.
People find it, and of course there's viewers, and then there's critical acclaim. The Emmy nominations came out yesterday, and Romain and I were talking about how Hulu did really well, right? You had Shogun, you had The Bear, and then HBO also did fairly well. But Netflix kind of didn't. It did get nominations, but not to the extent that the other streamers did. So that's a bit of a concern, is it not? At least in Hollywood, because they spent a lot of money on that content and they spent a lot of money promoting that content.
I kind of feel that when Netflix started, like House of Cards and that, it had shows that really kind of appealed to the critics and sort of an edgier audience. And now it's just much more broad. It's almost like the CBS of streaming. And you think of a soapy show like Bridgerton or whatever, very different from the edgy stuff. And Hulu has sort of become kind of the new HBO. If, look at The Bear or something. I mean, just a really, kind of a dark, show. Never see that on broadcast TV.
Yeah.
So I think that's what's happening. It's just become a more populist streaming service.
Yeah, and it's interesting, too, though, when we talk about the success of something like The Bear and Shogun and the idea that it's showing up on Hulu as opposed to where you would think it would show up, it raises a question, too, about sustaining that type of prestige content, if you will. I mean, not only critically acclaimed, but obviously one of the most watched shows out there here. Do you think that the streaming services overall, not just Netflix, but all of them, are willing to still commit the type of money that it's going to take to create these new shows?
Well, we just broke the news this morning that Apple TV is looking to license more movies from competitors. A reflection of this idea that it's very difficult to create these big blockbuster movies on your own, and so we're seeing a lot of that across the business of companies licensing their shows and movies to other competitors. It's all starting to blur between the services. So I don't. I think Netflix has gotten so far ahead of everybody else that it's got a portfolio right now that no one can touch it.
Yeah, I mean, I can watch How I Met Your Mother reruns either on Hulu or Netflix, but I do it on Netflix because it's easier to navigate. That idea that Apple's going to license more content is certainly welcome news to companies like Paramount and Warner Brothers Discovery, which would welcome the cash inflow that would create. There was a report in the FT, Chris, about Warner Brothers Discovery perhaps splitting up into two companies, its assets, the legacy TV assets, and then its studio and its streaming assets. How much credence would you give this report?
A lot of analysts suggesting that maybe this isn't the right way to go, but something will happen. And I think that's the reflection of Warner Brothers stock moving up. And I think David Zaslav, the CEO of Warner Brothers, acknowledged that there needs to be more consolidation. HBO was the premier way to watch, that prestige TV in the past, and it's sort of buried now in the Max streaming service. And how that stands alone, or if it stands alone going forward, or if it partners with a Paramount Plus or a Peacock, that's, I think, the direction things are going. Separating the sort of dying traditional TV channels from the streaming service is problematic, I think.
Yeah, because it needs the cash flow from the legacy businesses to fund the streaming business, to continue to build that out. So how do you do all that? Chris, thank you so much for talking through all of that with us. Chris Palmeri, of course, joining us from LA. We want to move on now to our top three, where we name drop some of the people driving the day's most talked about stories. And here's one. Connor Teskey. You may not have heard of this 36-year-old, but you will soon, because he is being groomed to be the next billionaire CEO of Brookfield Asset Management. The current CEO, Bruce Flatt, is 59, and he's preparing Teskey to succeed him.
Yeah, I mean, this is great for him. Obviously, he's been a wonder kid and kind of been bubbling up. But yeah, it's interesting to see how they've kind of placed him really kind of on the precipice. And there are a lot of people trying to make comparisons to Howard Marks when he kind of was kind of pushed out there in LA kind of on his own and basically just made a name and a fortune and really an industry for himself, and whether Teskey really has a chance to maybe repeat that or maybe do some version of that for the modern era.
And I'm glad you bring up Howard Marks, because Teskey's big achievement was pitching the idea of taking a controlling stake in Oaktree.
Absolutely,
so
he did.
Full circle.
All right, I'm keeping an eye on someone who's, I guess, already at the mountaintop, Ken Griffin, with a multi-billion-dollar fortune, and now peeling off about 1% of that fortune to buy a complete Stegosaurus skeleton. This, according to the Wall Street Journal, a $45 million price tag here. This was an auction at Sotheby's. Apparently, this was found in Colorado on like somebody's ranch or something here. I guess when you have this much money and, I guess buying cars and clothes just doesn't do it for you anymore. You buy a Stegosaurus. Where does he keep a Stegosaurus?
That was what I was wondering.
Yeah.
Like, what do you do with that?
Yeah.
And I looked into that, and apparently he's going to lend it out to a museum in the U.S. But my other question is, why Stegosaurus?
I know. Stegosauruses are whack. I was like, when I was a kid, I used to love the Triceratops.
Yeah.
Because they had the little horns.
Or the T-Rex. I mean, you've got to go with the T-Rex.
T-Rex is overrated. They got the little arms. And
the little arms are a little bit,
I remember as an adult, I found out that apparently T-Rexes weren't like the apex predators everyone made them out to be. Yeah, apparently they're kind of wimps. And they were saying like they're more scavengers than they are hunters.
Whips?
Yes, you heard it here first.
They got to redo Jurassic Park.
I think we have a third person to get to, unless we want to continue with dinosaurs, because I can talk your ear off about dinosaurs all day. So
all right, Sam Altman is third on the docket. The OpenAI CEO staking a sizable chunk of his personal wealth on a startup chasing the holy grail of nuclear fusion.
All right, well, if he manages to do that, maybe one day he, too, can afford a Stegosaurus. We'll be back here on The Close, right here on Bloomberg.
Just $45 million. That's all. Netflix, the first of the major streamers, reported earnings today, with Apple, Amazon, Warner Brothers, and Disney expected to report next month. For more, let's bring in Geetha Ranganathan of Bloomberg Intelligence. And Geetha, you can see the stock moving down about 2% in after-hours trading, even after that blowout beat on the subscriber addition for the second quarter. What do you think is driving the stock lower right now?
Yeah, a couple of things there, Scarlett. Obviously, a blowout when it came to subscribers, but I think their revenue guidance for the third quarter definitely was a little bit lighter than what investors were expecting. I think consensus was looking at more like mid-teens, so 15 to 15.5% revenue growth. They came in at about 13.9%. And then something that kind of caught my eye through the report was that there's a little bit of a subscriber slowdown in the U.S. And that's not good news because the U.S. and Canada are basically their most valuable subscribers. They bring in about $17 in revenue per month. That's double the rest of the world. So, when they're not adding enough subscribers in the U.S., that obviously has a direct impact on their revenue metrics as well as profitability.
What about internationally, Geetha? Is there any hope for additional growth or more meaningful growth out there?
Well, there absolutely is. I mean, international is where all of the growth is going to come from, Romain. But it also there's two parts to that. It's a double-edged sword because yes, you can boost a lot of the subscriber metrics, but then it is going to be at a much lower price point. So that's something that I think investors are going to have to grapple with, especially as Netflix stops reporting or stops giving us the granularity in terms of subscriber metrics as well as average revenue per member.
Do we have any sense of how big Netflix's ad-supported tier is? I mean, we know that I think in May, Netflix sold advertisers 40 million global monthly active users, up from 23 million. How sizable is that relative to how big it should get?
So right now it's not sizable, and they actually called that out in their shareholder letter. So they said do not expect advertising revenue to be material either in 2024 or 2025. And I think that's another cause for some investor concern. Having said that, though, I think it's still very, very early days. I mean, they're taking all the right steps. They're building all of the tools that can potentially make this a big business. But I think right now, I mean, if people had expected some amount of momentum and traction, I don't think we're getting to see that just yet.
Geetha Ranganathan, one of the best in the business over at Bloomberg Intelligence. A closer look at the results out of Netflix. Those shares remain on the back foot. A lot of concerns about its long-term growth, and of course, a long-term growth that has to be aided to some degree by additional content. That gives us a nice segue here to talk about production in Hollywood and a bit of a reality check going on out there right now. Data from Film LA finds that filming in Los Angeles fell 12% last quarter, led mostly by a decline in reality TV production. Shoots for reality TV slumping 57% from a year earlier. All of this showing the industry's slow recovery since the writers and actors strikes of last year. Patrick Adler joining us right now. He's a co-founder of Westwood Economics and Planning Associates, an assistant professor at the University of Hong Kong, and of course, deeply involved here in some of the numbers that we're just going through. Let's start off here first, Patrick. When we talk about the decline in jobs and the decline in activity that we're seeing in this space, is that a direct outgrowth of last year's strikes, or is this more about economic conditions, or rather a reimagining of conditions within Hollywood itself?
Yeah, it's really the latter. Employment in Hollywood peaked in August of 2022 and has lost, or it did lose 59,000 jobs between that period and the end, or rather the low point of the strikes. The big reason for that, as you gesture towards, is these like macro conditions, higher interest rates, meaning investors are less comfortable with lending money to invest in libraries, and also a little bit of runaway production from Los Angeles to other parts of the country that are now shooting movies.
This has been an issue for California for a while, particularly when it comes to location shoots and the idea that Hollywood has sort of looked for other places to do these things, whether it's up there in Canada or really other parts of the U.S. for that matter, where maybe you get more favorable cost conditions here. Is that trend something that California has a plan to push back on, or is this just a natural evolution of the industry?
Well, what's really difficult about this problem isn't so much that California doesn't have a plan, but that the underlying cost of living in Los Angeles versus, the rest of the United States or lower cost places overseas, that gulf is just too high. So, the state of California could unfurl a really ambitious incentive package, tax incentive package, and still not really hope to make up this big cost of living difference.
Okay, if that's the case, and that means cities like New York, London, Paris may face similar hardships going forward as well, no?
Absolutely. This is a challenge for New York and London as well. And, it's really up to these places to diversify away from, this film and television production, to other parts of the entertainment industry, and B, for this reason and other reasons, focus on cost of living as a serious competitiveness issue.
One thing Romain highlighted earlier was that shoots for reality TV slumped 57% from a year earlier. Can you tell us a little bit about the talent on the production side that is required for reality TV shoots versus scripted production? I imagine that there's a lot more. They have to be nimble. They have to be ready to shoot at any hour of the day. They might have to not chase someone down, but it's not confined to a set necessarily. And what the talent for that looks like in a place like Los Angeles versus in other parts of the country.
Yeah, in a lot of ways, this move toward a more digital or virtual office is really conducive to something like reality television. You think of maybe the vanguard of reality television, it's editors, and editors can do their job in a lot of different places. They're not confined to a set. But even in spite of that, these sort of headwinds are really facing Los Angeles and making it harder to hold on to this kind of employment.
What's kind of the future of this? I mean, as you just heard, Scarlett, she clearly watches a lot of reality TV because she understood exactly how these camera people have to operate. In all seriousness, though, it gets to the question, though, too, as to what type of content do we think we're going to see more of coming out of these streaming services? And that will probably end up, I think, to Scarlett's point, dictating where that stuff gets filmed. If it is kind of the traditional studio lot type of stuff, then maybe, yeah, California can make a comeback, or Atlanta or some other city. But if it is more of these reality type shows, does that then drive the narrative and, more importantly, drive the jobs?
Well, I wouldn't want to undercount. I mean, I think Los Angeles does a really good job of producing the sort of talent you need to do reality television at the highest level. And Los Angeles also produces a lot of below the line, big teams, talented workers to work on traditional film and television. So I think both of those types of production are really facing the same issues. But again, across the board, it comes down to how expensive is it to live in Los Angeles, and therefore how much do we need to pay our workers? And then there's also just, I don't want to underserve these macro trends where just the overall level of production in film and television seems to be lower now than it was during the so-called peak TV period.
Yeah, absolutely. Well, we knew that couldn't last forever, and it didn't. Patrick, really appreciate your joining us. Patrick Adler is co-founder of Westwood Economics and Planning Associates. I actually don't watch a lot of reality TV, but I started reading a book recently called Cue the Sun, The Invention of Reality TV.
So you say, okay.
So that was fascinating. And you know the reference of Cue the Sun, what it's from the Truman Show.
Oh, I forgot. With Ed Harris and was it Jim Carrey?
Jim Carrey, yes. He tried to run away, and then at one point Ed Harris said, "Cue the sun," and then the sun comes up over him.
I know, and who knew that movie would be more prophetic than it was fantasy? But it gets to the idea too of like what type of content do we want to watch, and what's going to be most profitable? And you've seen, I mean, like, let's face it. I mean, the cost structure for a lot of those reality shows. I mean, they pay those quote unquote actors basically next to nothing.
Yeah,
You're basically
paying
the crew and editing, right? And you promise them a future here. But anyway, interesting to see.
We're all going to be watching the reality show of the 2024 elections. That's the reality show everyone's going to be paying attention to.
Yeah,
you can't ignore it if you wanted to.
Yeah.
The markets have tried to ignore it, but they've gotten sucked into it as well. Let's take a look at how things closed on the day. A lot of red arrows there, and what's notable, of course, is the decline in the Russell 2000, larger than in the S&P 500. So that's a change from the last 6 days, 5-6 days or so.
Yeah, absolutely. And you think about this idea, like that big rotation that we kept talking about, and this was always the fear, right? That we had seen this before earlier this year, where you get 4 or 5 sessions, then it peters out because everyone just decides, okay, maybe it's not prime time yet. I wonder if that's what we're seeing today, or this is just kind of a blip in that big rotation trade. Maybe we'll find out tomorrow.
And euro also weaker as the ECB opens the door to more rate cuts later on this year.
The peso did today? It got killed today.
Did it?
Yeah, and it wasn't just because of the dollar. It was more because of the yen and a lot of concerns going on over there as well. I just want to point out, too, Bob Newhart passing away.
Oh, no.
Yeah, I mean, he was 94 years old. So I just wanted to point that out. Speaking of television, I was a big Bob Newhart fan.
Yeah.
When I was a kid. Remember the second show he had?
What was it called?
I think it was called Newhart. He was like, hey, I'm Larry. This is my other brother, Daryl. My other brother, Daryl.
No, I don't know that one.
That was funny.
I watched Three's Company.
I'll chuckle about that in my head. I think we have to go to break. We'll be back in a moment. More on Netflix in a bit. This is The Close.
Fans of both Netflix and American football will have the best of both worlds this holiday season. I know it's far away, but it is coming. The streaming giant will air 2 NFL games on Christmas Day. It's part of its push into live events and sports. Here with more is Randall Williams, Bloomberg News U.S. sports business reporter. And what's remarkable about this is that the NFL really did this specifically for Netflix, because the NFL didn't used to broadcast that many games on Christmas Day.
It didn't have games on Christmas Day, but the NFL kind of found a loophole. The games are on Wednesday this year, and Thursday is Amazon's day, Monday is ESPN's, Sundays are obviously everyone else's. So Wednesday is a day where no one had those games, and Netflix bought those rights.
Did they ask the NBA about this? How does the NBA feel about them honing in on Christmas Day?
The NFL is a media juggernaut, and when they want to take over something, they will. And they have a lot of young stars. We have the Chiefs and Steelers and the Ravens and the Texans, 2 or 3 teams that I'd say are attract a large audience. And so I think people are going to really enjoy those games.
Do we have any sense of how they're going to present this to people who don't have Netflix? Like, you have to sign up for a regular membership in order to gain access to these games? Or
I imagine that's exactly what it'll be, because Amazon did this, Peacock did this as well with the Peacock streaming game that happened earlier this year. I believe it was for the playoffs. And so I imagine for Netflix, it'll be like sign up and watch the game. And I mean, it's the NFL, it's Patrick Mahomes, it's Lamar Jackson, it's CJ Stroud. People are going to want to watch those games, and I expect Netflix to see an increase in signups.
And go ahead.
No, since it's a Wednesday game, is this a one-off? Do we expect this to happen again next year?
I'm not sure. It remains to be seen. When this deal was struck, there was the NFL's broadcasting partners weren't too happy about it. So I think next year, when Christmas Day is back on Thursday, Amazon will have some of these games, maybe CBS or NBC or the existing media partners.
And just to be clear, though, I mean, this is pretty much the future. I mean, some sort of, hodgepodge of streaming deals and day. I mean, we laugh, but I mean, some of us who are just old school would like to just see all this on one channel, so I don't have to search around for what streaming service the game is on. But I assume that I just need to give that dream up and just embrace the future.
The way that the NFL makes most of its money is these national media deals, and so I don't think. And I've spoken to the NFL about this numerous times. As of right now, the NFL is not going to go all streaming, but where it can make $75 million a game, $110 million a game with Peacock and NBC, they're going to. And so for people like you, you're going to have to sign up.
Oh, gosh.
Netflix also going to be airing Worldwide Wrestling, WWE. They're not games. What are
World
they?
Wrestling Entertainment.
Thank you.
It's real stuff.
Okay.
Be careful.
Do we have any sense of whether they're going to do that differently, like put their own spin on it, or it's going to be what's been shown in the past just on Netflix?
I'm not sure what the broadcasting team is going to look like. I imagine that they try to enlist a team from one of the existing broadcasting partners instead of hiring their own. I don't know that would make too much sense, but we're going to have to wait and see. It'll be a brand new broadcast, and I think everyone's pretty excited to see how Netflix will do with the NFL, because maybe they'll try to get in for the next media deal if it does go well.
So as these media deals, or this latest crop of media deals finally starts to come to fruition and we start to see the contours of it here, when you look at the material difference between the last deals, which they seem to be a little bit more tepid about the streaming services, and now this one seems to be, if not a full-on embrace, certainly, okay, we have to accept the reality here. Do you ever envision a day where maybe this all ends up on streaming platforms and leaves behind the traditional broadcasters?
Not for a long time. Not for a long time. Specifically with the NFL, not for a long time.
Yeah.
I mean, look at the partners right now. All of them, or a good portion of them, have their own streaming service. But quite frankly, there's a lot of people who are just going to a bar, going to sit down and want to just flip on the channel as opposed to having to subscribe somewhere. So not for the foreseeable future, but if streaming continues to win and the platforms continue to grow, then maybe 20 years from now. But I don't see it happening for the next media deal or in the current one either.
All right, Randall Williams, who covers sports for us here at Bloomberg. A closer look here at the latest media rights deal involving Netflix and the other streaming platforms. Fitting, too, that this week is also the release and the return, we should say, of EA Sports' college football game, College Football 25. Of course, a very popular game that got suspended because of concerns about not actually paying people who appear in this video game. That has now been resolved here, and now it is out, at least for some folks already getting their hands on it, and for the more traditional folks, you'll be able to buy it starting tomorrow. Martin Yang joining us right now over at Oppenheimer. Talk a little bit more about the new series, and there's a lot of hype around this and a lot of questions as to whether College Football 25 might become actually the dominant sports game, at least when it comes to football over at EA, maybe even supplanting Madden.
I wouldn't go so far as supplanting Madden, because you have to bear in mind that Madden is supporting both PC and 2 generations of console games. So when you think about the addressable audience for the games, college football is less than half of the addressable audience of Madden. But this year's college football does have that potential to be a breakout success, certainly a top 10 game for 2024 in the U.S. market.
Have you had a chance, Martin, at all to put any numbers on this in terms of what you expect in terms of sales, at least initially out of the gate?
Sure. There are a couple of ways to triangulate the numbers. Historically, the game sells up to 2 million units. That was 10 years ago. And I think management's expectation is around 2 to 3 million, but based on the pre-order or the early access player count, we think total, based on the early access player count was close to 700K. And in the most optimistic scenario, that translates to 2.5 million of unit sales for the year. And I think, for the year, we are certainly looking at a number bigger than 3 million.
Okay, so that's unit sales, that's top line, but we know EA Sports spent years building this new game from scratch. It had been 11 years since the previous version. They even pushed back the release date by 1 year, so they spent a lot of money here. What is the break-even point for EA?
I think this will be a moneymaker for EA from year zero, because they share a lot of technology, particularly the core game engine with Madden. So a lot of the character capture, animation, and even engineering, development, and creative arts all can be shared with the same infrastructure that Madden has developed for years.
I see. Okay, will there eventually be built-in options for sports betting that would help generate additional revenue for this game, do you think?
I think EA has an open mind regarding business models. For example, they are introducing potential brand partnerships to other sports games. So I think this will be an option if EA is open to it.
Let's talk about EA overall, Martin, because we talk about this game potentially being additive to the company's bottom line going forward. We're going to get earnings in a couple of weeks, and I know that's going to be backwards looking and not really taking into account college football 25. But when you look at the slate of games that they have now, and more importantly, the slate of games that they keep promising that they're going to actually finally release here, when do you expect to see material increase or acceleration in revenue growth, if at all?
We are going to see I would say revenue increase. I don't know how material that will be in fiscal 26 and 27, because when you look in the past few years, we are seeing maybe 1 or 2 large games launching, and none of them are as large as the top franchise for EA, like Battlefield. But in the coming 2 years, we're likely to get 1 Battlefield, a couple more single-player RPG games like the Black Panther games in development and Iron Man game in development. And there will be new live service games like Skate, The Sims coming out as well in the next 3 years. So in terms of the volume of games coming up and the size of each game, they'll be bigger. So it's pretty predictable that they will have a bookings growth from now to all the way to fiscal 27.
And when you look at industry-wide trends and the growth in gaming, Netflix has talked a lot about, Reed Hastings, the CEO of Netflix, has talked a lot about this idea that they don't necessarily compete with the other streamers. They're much more concerned about eyeballs being stolen by video games. There was a good report out by the folks over at Bain Capital basically saying this is now approaching something like $300 billion in industry-wide revenue by 2027. And that's a huge jump up from where we are, I don't know, just maybe 2 or 3 years ago, something like double.
Yeah, certainly. Video games itself is trying to reach out to different format that complementary to the more conventional interactive media. So we are seeing this competition between interactive media like video games and linear video. So video games more and more will try to take the format of short form videos, social media, trying to compete any of the users' leisure time.
All right, Martin. Appreciate you joining us today. Martin Yang, analyst over at Oppenheimer. A closer look at EA, the release of its latest college football game and the potential for that gaming industry to continue to expand. We do want to turn back to the world of politics right now. We have been keeping an eye on the Republican National Convention and the formal nomination of former President Donald Trump. We're also keeping an eye on the current president, President Joe Biden. Of course, testing positive for COVID. laying low for right now, but still a lot of questions circulating about whether he should stay in the race. Reuters now reporting that Joe Biden has done some soul searching about his place in this presidential election cycle. Bloomberg's Tyler Kendall joining us right now. She is out in Milwaukee at the RNC. And Tyler, fill us in. I mean, there's been so many headlines crossing now on what Biden is doing, what he's thinking, and more importantly, what his friends and his allies want him to do. What do we know right now?
Right. Well, Bloomberg News is reporting that there is this mounting pressure on President Biden from close allies to essentially step out of the race. Now, this report just coming from Reuters that he's taking it under clear consideration. So far, the campaign is on record saying that he will stay in the race, but it comes after some prominent Democrats have come out publicly calling on him to step aside just this week. Of course, Congressman Adam Schiff, who's running in a competitive Senate race, calling on President Biden to step aside, because we have to remember there are some keen down ballot impacts that this could have. Of course, there is that ABC report saying that there's potential that President Biden has asked for polling when it comes to Vice President Kamala Harris to step into the race. Our own Bloomberg News polling when it comes to battleground states have actually found that these battleground voters are more open to her as a potential candidate. The latest poll showing that 48% of voters in those battleground states would be comfortable if she ended up taking that top spot. So all of this is becoming mounting pressure. We're hearing some of the leaks coming out of some private meetings that President Biden has had. We know that his aides have been working with the Hill, because this is just as much about congressional races as we have these super tight margins in both the House and the Senate come November.
All right, Tyler Kendall out there outside of Fiserv Stadium in Milwaukee, the RNC convention taking place, the final night of it tonight, of course, with the big speech from the former president, Donald Trump. But of course, Scarlett, still all the attention right now still seems to be on the current president, Joe Biden, and whether all these calls for him to drop out the race are going to have an effect on his decision. And he is socially isolating right now because he has COVID. There was another report as well that he was planning to hit the campaign trail next week. As part of the whole, I'm not looking into potentially stepping aside. So he plans to move forward, officially speaking, with his plans to campaign. But campaign where and in what way, right? And it'll be a delicate balance, too, right? Because we talk about this idea here that the Republican convention's out of the way. You have the Democratic convention at the end of August here. And Biden already has all the delegates here. So this is almost perfunctory at this point. If he chooses not to do anything, he would basically have to make the decision and say, I'm ready to go. Maybe he hands it off to Kamala, maybe it's in someone else, but he has to make that decision. Yeah, although they were trying to accelerate the whole nomination, the formal nomination, and do it virtually. That back by a week. Yeah, and they pushed that back, so it's still not clear when that's going to happen at this point. Of course, we will have full coverage tonight of the RNC convention as we push ahead to some of the potential market-moving events over the next 24 hours. We will have special coverage right here on Bloomberg Television. That starts at 8 p.m. Eastern Time. Tomorrow, Scarlett, we also get more earnings. We get American Express before the bell, and that's always interesting, right? Because they've actually gained a lot of ground, particularly with younger credit card users. Gen Z has really flocked to American Express. They are picking up the premium card and really using the rewards, and also regional banks. Yeah, it'll be interesting to see how some of these regional banks are faring. Of course, more than a year removed from that so-called regional banking crisis. We do get some Fed speak tomorrow. I'm sure you'll be well into that, Scarlett. John Williams, as well as the second best Bostic out there, Raphael, over at the Atlanta Fed. And this will be the last chance that these Fed officials get to really talk about what they see, because starting Saturday, there's a media blackout before the FOMC meeting that begins next Tuesday and ends on Wednesday. All right, and we're also going to, we were just talking about EA Sports College Football 2025, the physical version of that going to be available starting tomorrow on Friday. And keeping an eye on sports, Scarlett, something else coming up as well this weekend. Yeah, the WNBA All-Star Weekend. I know our producer Moravia is very excited about this. Yeah, absolutely. And of course, this is probably the year where they're really having the coming out party, of course, with Angel Reese and
they're having
what was
their
the
moment.
other person? Caitlin Clark?
Caitlin.
All right, that does it for us.
Clark.
We'll be back tomorrow. This is Bloomberg.